Hello and welcome to this week's episode of Nucleus Investment Insight. Today it's Bond, Contrarian Bond. No, we won't be discussing James Bond, but we will be discussing the bond market. Bonds have had their worst quarter in about 50 years, and we'll explore if the worst is over, whether there's been an overreaction, and if there's an opportunity that they now go the other way. On the agenda, we'll look at the movements in bond yields. We'll analyze global tightening, fiscal and monetary policy from around the world. Again, we'll touch on the war, the energy shock, and the European economy. Next, we'll have a peek at the Chinese economy, their property bust, and the COVID shock. And of course, it wouldn't be complete if we didn't look at the US economy, inflation, and the interest rate shock also. We'll also talk about the Spanish flu and see if there's any similarities to today. And as always, we'll cover the investment implications at the end. My name's Sam Kerr, and I'm the Senior Financial Advisor at Nucleus Wealth. Today, as always, we'll be joined by the Founder and Chief Investment Officer at Nucleus Wealth, Damien Klassen. Damo, thanks for putting this great show together, and it's a pleasure to be here with you. Excellent. And thanks. We also have an equally sharp mind on the show today who will share his expert global macro insights, our Chief Strategist, David-Llewellyn Smith. Dave, thanks for joining us. How are you going?
Well, thank you, Sam. Thanks for having me.
That's great. It's going to be an interesting discussion today, and I'm sure everyone will get some insights out of today's episode. Just a quick reminder before we get started, if you enjoy our content, please subscribe to our YouTube channel and click the bell below to be notified when we go live or have a new episode recorded. Alternatively, follow us on your preferred podcast platform. Our show's available on all the majors. And for those of you listening live, feel free to drop your questions in the YouTube live stream chat, and we'll do our best to answer them during the show. So now we've got that bit of housekeeping out of the way, we'll get into it. So Damien, I'll hand it over to you to get us started.
Yeah, sure. So what I wanted to do was try and sort of, I guess, first put a little bit of perspective into the recent moves and just sort of run through some of the various facets of the bond market, and then sort of approach in more detail, whether this is an opportunity or not. So as you mentioned at the head of it, we've had sort of depending upon how you measure it, there's a whole bunch of different ways you can measure bonds, but I've seen some stuff that's saying it's the worst in 40 years. There's other ones out. I think if you look at it in a particular way, you can probably get back to the sort of 1920s before you get sort of a worst quarter in terms of bonds, or the worst sort of 3 or 4 months. And so, there's obviously this huge focus now and intensifying post the Russian invasion of the Ukraine on bonds. And I guess the question, whenever you have such sharp movements, is okay. Now, is this an indicator that things have changed and they're going to keep moving in a trend, and things are going to continue to be bad, or is actually this is there somewhat of an overreaction? And even if there's you might have a longer term strategic view that they're going up, there's sort of a tactical position about saying, will you have a chance to reverse on it? And so. So I wanted to move that. And so I've got a chart up, just sort of showing some of the bond movements in the US bonds. I just wanted to highlight, I've got a bond yield curve there. And so that basically is tracking the further you go out, what the different bond yields are. And so, and it's showing how the whole curve, it's basically been right across the curve, the whole curve moving up pretty much in concert. It hasn't sort of been the longer term bonds getting the yields blowing out there, and the shorter term ones not moving. It's just basically been a complete shift of the entire curve up across the board. Dave, if you've got any thoughts just in terms of movements before we get into some of the inflation?
No, I'll just note that I think we're already not terribly far from an inverted curve. If you look at anything from sort of the 5 to 6 further out, it's pretty flat already, and has flattened, as you can see, from 6 months ago. It was materially steeper, and so Basically, as the RBA has capitulated into a rate tightening cycle, we're starting to already see some of the flattening of the curve that you would expect for a cycle that will culminate in, slowing growth and falling inflation.
Yeah. So just about to be, I guess I'll just put that in perspective. When we're talking about flattening and steepening, what David's talking about is this yield curve, which some of you if you're watching YouTube, you'll be able to see on the right. But it's basically what it's saying is that if you can borrow, if Australian government bonds at the 10-year level are say 3%, and you go back to the let's say the 2-year was also 3%, you'd say that was a very flat bond yield curve. And if it even got to the stage like it has in the US where it actually went negative, so the yields are higher on 2 years versus what they are on 10 years, then that's called an inverted bond yield curve. And what that usually signifies is that there's going to be poor economic conditions going forward, or a recession, because basically the expectation is rates in the short term are going to go up, but then they're going to be actually falling over the longer term as we run into a recession or more negative events. And so then, as we're talking about that flattening, that's what you'd expect to see. And so now we do, and I'll go a little bit more into the steepness of these in a minute. So next thing it's worth highlighting is inflation expectations. So these have rocketed over the last little while, and I've got a chart up here just sort of showing that the dark blue line is the pricing of inflation, which is, we think, probably the most accurate view. And you can even get a little bit more detailed in terms of this about which areas of the curve, what are people pricing for inflation for the next sort of 4 or 5 years, and then what are they pricing for from 5 years to 10 years, and that sort of gives you an idea about where the money's going and what the expectations are that are baked into investment markets. And so at the moment, we can see that's sort of still not that far off the midpoint in terms of the Australian target is between 2 and 3%, and so it's still pricing a little bit above 2.5% in there at the moment. But some of the other expectations, so say your business inflation expectations or union official, they have really taken off in the last little while, and they tend to be a lot more volatile and have less, I guess, have less predictive power than the pricing one you get from the market. But at times they're better. So, sometimes the markets get it wrong. And so, and you get it from these other ones. But I think there's, and if you look at consumer ones, consumers consistently think inflation is going to be way higher than what it really is. And so sometimes the consumer, the movement's useful, but the actual levels of it often aren't. So, and that's a global phenomenon, all that inflation expectations. And
it's not terrifying blowout though, is it? I mean, it's just, we're not even, I mean, our business is kind of outstripping the others, but most of them haven't even popped back above 2012 yet. So and actually the business one there is a short-term one anyway. It is. Yeah, it's sort of 3 months. Yeah. So that's sort of and I'll add the NAB survey that comes from is not what it once was either. Like ever since the GFC, it's struggled a bit to be precise, I guess. To deliver a precise reflection of the economy. It's useful, but it used to be quite accurate. These days, it's more of a guide.
So what this means as well is that mortgage rates have obviously jumped, and that's we've got the next chart up is just sort of showing that when are they expiring, because that's pretty key. So different markets around the world have different pricing in terms of how they treat mortgages. So the US, most of the time people take out 30-year mortgages, and so the effect of interest rate rises on existing mortgage holders is actually very low. It's actually just it's the new mortgage holders that where it really affects, and so the new home buying. In Australia, usually we've got a lot more people on the standard variable rates, so these interest rates rises start to flow quite quickly through. But that hasn't been the case in recent years. In recent years, what we had was the RBA put on a special facility to bring down the 3-year mortgage rate. And what that meant was that a lot of people loaded into that 3-year. And we've got a chart just here showing the expiries of those from Commonwealth Bank, which is about 30 to 40% of the market. And so, we're pretty sure that what we're seeing in the Commonwealth is reflected elsewhere. And you can see that really starts to build up. So the next 2 years is where you really see that start to roll off. And so the next half, there's going to be a reasonable amount, $20 billion worth of mortgages from CBA, which is probably means 50 billion sort of across the market in the second half, and then intensifying from there. So the effect of those low mortgages that everyone did is going to progressively start hitting the market. But it is absolutely hitting new home buyers already. And that's where, we're obviously starting to see house prices start to fall already. And so stopping new, but the effect on existing mortgage holders is going to be a bit more gradual, but certainly very much concentrated over the next 2 years.
And it's big.
Yes.
I mean, it's basically almost all of 2 years of mortgage issuance is going to reset. $500 billion in mortgages, and they're not going to reset a few basis points. We're talking from sub 2% for most of them to, say, a 2% average, to what the variable is 3.6 today, but the RBA is going to hike whatever it's going to hike. CBA itself is forecasting 4 hikes before the RBA stops, in part because of this, because you would have, this extraordinary pig in the python of mortgages resetting at double and above, which I'm sure Australians have prepared to some extent, but I don't think a lot of people are prepared for that. So this is one of the reasons why we've been much more bearish, I guess, about the terminal interest rate in this cycle for Australia because of this reset, which should hit household incomes pretty hard, and perhaps even cause some distressed selling in the housing market.
Yeah, so that's I guess the thing to remember is that the housing market's very big in terms of it being sort of 11 million odd houses, but not that many turnover every year, and so you don't actually need that much of a fall in demand at the margin to really actually start to push prices up, as we've seen, or also push prices down. And so that's where we're sort of starting to look at now. So okay, so we'll get on a little bit more into these economic impacts as well. But the other thing,
your question here. From one of our viewers, Samuel, he's saying that he's got a house deposit saved and wants to know what the pros and cons between having it sit in the bank versus having it in bonds, especially with high inflation and the likely rate hikes.
Yeah. Okay. So basically, the thing with a bond is what you're going to get back on the bond the day you buy it. If you're holding to maturity. So let's say you buy let's say you wanted to buy a house in 2 years' time, and you buy a 2-year bond, Australian government bond, corporate bond. You've always got the risk that maybe the company's doesn't pay it all out. But say it's Australian government bond, you can say, okay, well, I know I'm going to get a 2% yield over this, so I buy the bond at $100 today. I get my $2 or $1 per every 6 months, and then at the end of the 2 years, I get back $100. And so you're locked in. Doesn't matter what rates do, whether they go up, whether they go down, or whatever. You're locked into to that return. If you put your money in the bank, then you might get a 2%. You might end up getting a 2% return if you might average a 1% return over the next year and a 2% return over the year after, or a 3% return over the year after that, say, to give you like a 2% average return over it. But you're at the mercy of markets. If interest rates go up, you'll get more. If interest rates go down, you'll get less. And so I guess, and the way to think about this is, in the interim, if you are thinking about trading that bond, the value of that bond will go up and down. So a bond, you're fixed on your cash flows, but the value of that bond will go up and down over that period. Whereas if you're in got your money in the bank, then your capital is fixed. So if you put $100 in, your $100 is your $100, but the amount of interest you're going to get will be variable depending upon what happens. And so, I think if you're looking for something that's an immediate option, then cash is always the best bet. If you're looking for something to sort of lock in a return, then bonds can be good. And if you're looking for something that you're using as a bit of an option as an investment portfolio, that's where bonds get even better, because if we do go into a substantial downturn, then bonds almost always go up. There's some circumstances where they don't, but if we're talking about inflation coming back down, and the whole panic around, are we headed for stagflation? If we're talking about that going away, then bonds will, the price would tend to go up in that case. So you might be able to buy, say that bond you bought for $100, you might find that the price of that bond might be $102 in a year's time. So you've got $2, you've got your $2 into the interest, but your value of your bond's also gone up. And so you've got a 4% return, and you can sell that bond and take it from there.
You might say that in that case, you've got a bit of a timing issue as well. I mean, the reason interest rates are going up is inflation is, pretty strong, and yields are going to fall and capital values go up in bonds when the market starts to get the sense that the central banks are on top of that. But at the same time, if you're looking to make a bit of money just before you go in and buy property because interest rates are going up, you don't want to get yourself into a position where you might miss that timing with the peak in inflation. You could see inflation rise a little bit for a while, and then yields go up and bonds go down for a bit. So your horizon might not suit bonds right now, and if I were you, I'd probably be looking at cash, which is not advice, but if I was in your circumstances, I'd say I'd probably
depending upon the time frame. If this is like I want to buy something in the next 5 years, then you got more
exactly right.
Than if you're sort of saying I'm looking now, and if I find something in the next 12 months, I'll buy. And
if you're looking to try and hit the property market while it's in distress as well, then you want to be liquid at the point of when that's most obvious, which looks like it's going to be next year, and so you're playing with pretty short terms with what you intend to do with the money versus the duration of what you're contemplating to do with it in the meantime.
And let me give you an example of the 2-year bond. So let's say interest rates go to 4%. So that 2-year bond, we've bought a 2-year bond on a 2% return. So we bought it for $100. It's going to pay us $2 next year and $2 a year after. If over the year bond yields go to 4%, or the 2 year, and so what would happen then is I get my $2 over the first year, but my bond value actually falls back to $98. And so that means anyone buying in a year's time will have a year to run, and they'll buy for $98. They'll get $2 in capital return because they're going to get $100 back at the end, and they'll get $2 in yield. And so that's where the 4% sort of come from in terms of the way the market would look at it. And so, that's what happens in a two-year bond. Whatever happens in a 2-year bond, if you look at that for, say, a 10-year bond, you can basically multiply all the numbers, not quite by 5, but the returns get a lot bigger in terms of what you can see in terms of in terms of those. And if you're going to like 30-year bonds or something like that, you can lose a lot of money or make a lot of money from some of those longer term bonds. So yeah, if they fell back to 1%, you'd probably be making sort of 10, 15% on some of these longer term bonds. Right. So that's the I've got a chart up now of the yield spreads. So the yield spreads, and what I'm talking about there is saying what's the Australian bond minus the US bond, and the Australian bond tends to trade on or tended certainly over the mining boom to trade on a higher yield than the US bond, and so we can see that the spread between them was on the 10 years probably the best one to look at. Is because the other shorter term ones can be put out of place more by short term events, but it's sort of around that 2% level above. as the Australian economy sort of got worse, and we had the Trump tax cuts, and the American economy sort of booming towards the in the second half of that decade, the 2020s, that sort of in the run up to 2020, Australian bonds went to a negative spread on the US. In recent times, they've actually jumped up, and they're sort of now back above zero in terms of the yield spread, which is sort of basically saying that the Australian economy is expected to be much stronger than the US economy, and that's where I guess we start to So that's where we've got a view that, look, that's not the case. If you've got a view that commodities are the boom and they're going to be the boom for the next 10 years, then this matches. But if you have a more negative view on commodities and you feel like the Chinese slowdown in China and a number of other factors are going to come back to roost, then this doesn't make as much sense. Dave, any yield spreads?
Some of those other factors, obviously the mortgage reset that we've just been through is pretty crucial to our view on that as well. And I guess the other stuff will come out over the rest of the presentation. But
so then we go to the steepness of the bond yield curve, and so that was this. And there's a bunch of different ways to look at it. We've just simplistically looked at the 10-year minus the 2-year. So we spoke a little bit about that. This is just graphing that over time, so you can see that the Australian and the US bond yield curves do move pretty much in tandem in terms of the steepness of the curve. Having said that, for the last couple of months, that has not been the case. So we've seen the Australian bond yield curve sort of getting steeper, and the US flattening, and you can even see that sort of it hit at one point, a couple of weeks ago, it actually inverted momentarily. And so there's certainly something going on in terms of the expectations that are being priced in terms of saying, as yields go higher in the US, they're pricing in a greater chance of a recession, whereas Australia seems to be doing the opposite.
Which has really taken off after during the whole Ukraine war, which saw this kind of final manic leg up in commodity prices, which has, done a couple of things. One of them kind of made Australia exceptional in terms of the steepness of the yield curve, as well as protected the ASX a lot more than some other bourses.
And also the fact that I guess the RBA has been slower to move than most other central banks also probably falls into that less chance of recession, because if they're slower than everyone else, and then the US starts to roll over, maybe that'll slow the rate of rate rises in Australia.
Yeah. I put it to you, though, if it weren't for the Ukraine war, we would have seen a lot more flattening here, given the state of China is pretty dire.
Yes. Yeah,
so,
absolutely.
like the commodity mania that's developed before that, but then exaggerated by it, has really kind of removed commodity prices from the Chinese influence almost completely, which, of course, one has to ask if that's sustainable.
Yeah. Okay, so let's have a quick look now. Risk return. So what I'm looking at here is I'm just got the looking at all the different, or the G12 plus a couple of other countries in there, Norway and New Zealand, just because they're similar countries to Australia. And what we're comparing is that the 10-year bond rate you can get versus the CDS spread, which is basically an insurance in case it goes broke. So the top left, is the low yield and high risk countries, and bottom right is the high yield, low risk countries. And so Australia, which in theory, your most attractive ones, and Australia and New Zealand are both sitting in that range. I think it's worth noting that within this, there's there are other factors at play. So inflation's another factor which we'll look at it again. But this is sort of saying, well, which countries, when we look at the pricing of it, and Italy is pretty clearly an outlier there, is a market's actually pricing a fair bit of that Italian yield is because people are worried about that it might not actually be able to make good on its debts. And so, the fact it's trading on a higher yield than, say, a lot of the other European countries like Germany or Netherlands or France, at least a part of that is due to concerns over its solvency. So that's the CDS spreads. I don't think I put the CDS chart in there, but over time, that really hasn't made much of a difference to Australia. During the financial crisis, during the pandemic, those CDS spreads all sort of rocketed a fair bit higher. But current levels are low for all these countries. I think Italy was much higher, following the financial crisis. There's still no sign of panic, I guess, in terms of countries being able to pay their debts. The next one then is the real returns. So looking at in the latest core inflation rate, which is probably not as it's not as reflective, but it sort of gives you an idea about which countries are running the deepest sort of negative real yields, and traditionally countries wouldn't run any real yields that are negative. So I guess the argument is if inflation stays at 6%, then in the long term, 10-year bond rates should be well above 6%. It's an argument that one of them's got to move, and our contention is, and I think everyone's contention is, look, that these inflation rates aren't sustainable. It's just a question of saying, well, do they fall back to sort of that 1 to 2% level, or are they now going to be permanently higher in sort of a 2 to 3% level, and in which case eventually that will flow through to the pricing of bonds. But again, Australia sort of sits relatively close to the line, that they're not particularly deep real yields in terms of that. I don't know, Dave, have you got any thoughts on either of those two charts?
Damien, we've just got a couple of questions coming through here, just about inflation. So Craig's saying a lot of commentators seem to think inflation is going to come back down, and he wants to know why that is, considering state and federal governments will be running massive deficits for the next 10 years.
Yep. Can we actually we will talk inflation in a couple of charts. Let's pin that one for the moment. We'll come back to that when we hit commodities. Absolutely, it's a key measure for how you want to price bonds in terms of, and if you've got a view that inflation is going to stay high for a long period of time, you don't want to be in bonds. It's not the right. Maybe inflation-linked bonds might be the ones to get into. But normal bonds you don't want to own if you think inflation is going to stay anywhere near current levels for a considerable period of time.
I'll just say one thing on that, and that is it's the net outcome of the economy that matters to inflation, not just deficits. So, it's entirely appropriate and can be very disinflationary to run fiscal deficits if the private sector is retrenching, or you've got, the external sector, which is exports and imports, retrenching. And some of those factors are at play in the Australian economy. The one factor to remember is there's a lot of kind of infrastructure spending over 2022. So that is going to be inflationary in the short term for Australia, but it dissipates pretty quickly next year. So,
subject to whichever government wins and what.
Yeah, Labor may change that, but I think they'll probably be under pressure for a fiscal retrenchment, even if they win power. So
I'm pretty sure that if Labor wins power, that the Liberals will immediately flip to suggesting the debt is way too high and they need to pull back on.
Oh, of course they will.
Any manner of things, yes. Okay, so the next one, I just want to talk volatility as well. So this is probably key in terms of, probably not a key one, but it's worth just noting that the volatility of interest rates at the moment is particularly high. So it's sort of double its usual level. So that sort of makes a difference in terms of how financial markets are pricing it and the amount of leverage that they'll sort of allow into markets. So so that's one measure. The other one is that there's a sentiment. Sentiment is extreme. So at the moment, so there's a there's a number of different ways to look at the sentiment, but this is one. Actually, which one's this, Dave? This was so it wasn't titled actually. There's a sentiment indicator though for bonds which is basically at its as low as it's ever been, or close to as low as it's ever been. And do you remember which one this was from?
It's from the market here, but I'm not sure where they sourced it.
Yeah, but I guess the point is that when everyone all shifts in one direction, and you see hedge funds and investors all moving out of an asset class, and then they all become very negative about it. When it hits its extreme, that's usually when it's time for these things to turn around. And this chart, they've sort of highlighted a few of the points where the extreme was met, and quite often there's at least a short-term bounce in terms of the effect. And so that's where, I guess, regardless of what your longer-term view is, it does certainly seem as if we've hit this point at the moment where it's been a very sharp move very quickly, and I guess don't be surprised if there's some sort of reversal. The question, how long that reversal goes for, is I guess a bigger macro question. And then finally, I wanted to just look at financial conditions, and then we'll sort of move into the, what do we do about this? So the only other thing was the financial condition side, where I've got here, this is the Goldman Sachs global financial conditions. So they're not as extreme, particularly in the US. It's certainly tightened, but hasn't tightened anywhere near as much as this. And so what this is talking about really is the flow of excess liquidity into the market. And so when you tend to get this index going down, tends to coincide with markets rising because there's all this extra cash sloshing around. And then when things are tightening, so governments are either pulling back on the fiscal side or on the monetary side, or we're seeing credit spreads blow out, or equities or exchange rates move in particular directions, that can all sort of add to the tightening of fiscal conditions. And so right now, we're certainly seeing global conditions tightening, which is reducing that flow of money to the economy and to investment markets. Dave, any other thoughts?
I know. Carry on.
Yep. Okay, so now that comes back to the inflation question, and I've got a commodity price chart up there. I just wanted to show because the key thing you got to remember for inflation is a rate of change. So it doesn't depend upon if petrol prices have jumped and then they stay at current levels, you don't get inflation from that. Like petrol prices being high doesn't give you inflation. Petrol prices continuing to rise, that's what gives out inflation. And so the question with all of these, has to come back to the commodity price has changed. Will it now keep rising, or has it hit a level where it will then, it will stay where it is, or reverse? And the chart on the right, you can see the movement over the last year. And so we've certainly seen that as the war broke out, that just rocketing up in terms of this is an index of a whole bunch of different commodities all put together. But basically, since the war had started, it's struggled to find its way any higher. So it's sort of been in this range now of whatever 3,500 up to 4,000, where it's sort of prices haven't continued to rise. So we saw, say for example, oil rocket up to sort of $125 and then fall back down to 100. Yes, rising up to 125 is inflationary, but over the last 2 or 3 months, that fall back has actually been disinflationary for oil. And so the question for all these is there a regime in place in which we think commodity prices are going to keep rising? And so taking oil, for the example, if you had the view that actually gradually what's going to happen is all the Russian oil is going to go offline, and they're going to tighten sanctions, and that'll be offline for a long period of time, and the rest of the world doesn't have the scope to expand, and China's going to come rushing out of its COVID shutdowns, and so there's going to be lots of demand, then oil prices are probably headed up under that scenario, and you could keep seeing this reach new highs, and the inflation keep ticking over. If The view, however, is that, look, it's taking some time for Russian oil to start going. Rather than going to Europe, it's going to end up in China and India. And rather than that we're going to continue to see rolling lockdowns in China, which is going to mean that demand in China stays low, and there's expansion in US and there's expansion in some of the OPEC countries as well to pump more oil, and that means the oil price is going down or at least sideways from here. Then the impetus for inflation then is much less. There is actually. Let's do commodities first. Dave, you're obviously got a lot.
Well, what you're basically describing is base effect. So, if the price doesn't keep rising every year, then inflation is zero. It doesn't matter how much it's risen before; it's got to keep rising. So that's the first reason why economists expect, in answering the question earlier, inflation to diminish over the next 12 months, is because we've had really strong price rises, kind of at the most basic inputs into the economy in commodities, and that's flowed through over this year. But as Damo points out, those prices haven't continued to rise, and so even if commodities stay where they are, which has been a big spike, then the inflation will diminish next year automatically through this phenomenon of base effect. So that's the first reason. Then the second couple of reasons why we think that inflation will diminish. I mean, there's a whole bunch of them that are kind of embedded, and I'll go through those ones first, I guess. The major one is we've had all these supply side constraints during COVID and coming out of COVID, and also because of the Ukraine war and the Chinese lockdown now as well. But a lot of that, the underpinnings to those supply constraints are starting to unwind. So, we had this big pivot to goods consumption instead of services, which meant that we had a very exaggerated demand for, hard goods, and services had collapsed during COVID. Now that has started to reverse pretty clearly and dramatically worldwide. And so we're going to see that continue with goods demand, basically returning to a normal trend. And so in this kind of 2 or 3 year period, the logistics and what have you have struggled to deliver stuff. They've done all sorts of changes and build outs and efficiencies to try and get around or to fix these problems. And we're suddenly going to see a lot of the expected demand not be there. And so you'll see lots of supply side excess appear just unexpectedly. And so that's very deflationary for some of the things that we've seen over the last few years.
And a lot of onshoring as well. So we see a lot more people building factories in local countries. And
there's that as well. Some argue that's inflationary because you'd be pulling stuff out of kind of low-cost jurisdictions in supply chains around the world and putting them in your home country. And to some extent, that's true. But at the same time, if you do it properly these days with robotics, etc., it actually isn't particularly inflationary at all. And again, it leads to more slack in the global supply chain anyway.
Yeah. And there is an argument as well that sort of goes, well, if China's trying to produce as much as it can, and it's producing whatever widget, and somebody's just built an automated factory in Australia or the US to produce that widget themselves, is if China starts a price war, chances are the person who's just So now they're producing widgets. China's now not selling as much. So do they then lower their prices? And the yuan's been falling, so that sort of helps them straight away.
Yeah.
And then they come in with lower prices, and the person who's just built the factory then goes, well, I've already spent the money. It's all robots anyway. Okay, I was hoping for a 3-year payoff. Maybe it's going to be a 5-year payoff or a 7-year payoff, but I'll just reduce my prices back to, because it's either not do it, not reduce your prices and face making no money from it, or reduce your prices and chase down. So
and the 3 big reasons why we think inflation will fall away over the next kind of 12 to 18 months is, well, firstly, inflation itself has delivered what we call demand destruction. So because commodity prices shot up so quickly, especially in Europe and especially in energy, there's been a whole lot of shutdowns of uncompetitive industry and stuff. And so you end up, with this destruction component actually reducing demand for those very commodities.
Plus the demand destruction from, everyone would have felt it over here. You just spent, I usually fill up for $80 and just cost me $130. And so I'm $50 short this week.
Absolutely. So it
may not end up in at a restaurant or a
wider demand destruction as well. So in Europe, it's very energy focused, but it is global. And, you can indeed even get recessions directly from really, really big commodity price spikes. In fact, typically we get recessions after oil price spikes, in part because of this demand destruction phenomenon, and then also owing to the central bank response to the inflationary pulse it gives. So, the first point is that the war and the energy shock that is particularly relevant in Europe, obviously. So the European economy has really been hit quite hard. So that's, the world's largest economy is already, really struggling with domestic demand on those shocks. Then you've got the world's second largest economy in the US, where we've got the central bank response to this inflation pulse that's come out of these factors. With the US now, the Federal Reserve looking at 50-point basis rises for the next 2 meetings. Markets are even contemplating 75-point hikes. I don't think that's going to happen, but that's all part and parcel with this, the price discovery of where we're going. And so, the US has really gotten a worse inflation problem than elsewhere, with a tighter labour market and some sense that wages have started to rise and chase prices, although it's not extreme yet either, but it has, kind of begun a little. And so the Federal Reserve's on the move, and there are, all sorts of crazy projections on how high and how fast they'll have to go. But the point is they are going to move fast and high enough to stall economic activity. And so that's deflationary in a relatively short time frame. Most, the bearish kind of pundits of Wall Street are looking at the second half of next year as a recession in the US. We think the possibility is that it happens sooner, because this entire cycle has been defined by speed more than just about anything we've ever seen. So I think it's quite plausible that the Fed hikes really fast and finds itself with a very troubled economy very quickly. Because for the obvious reason these days that, a financialized economy is very leveraged and very sensitive to these kind of changes in prices. So that's the second largest economy is entering this inflation/interest rate shock. Then we have the third largest economy in China, which has got, probably the worst shocks of all going on, with an outright property crash in property construction, something that has not been seen there in 20 or 30 years. And now, of course, with Omicron escaping the noose there, rolling lockdowns with no end in sight either. Now, it's doing what it can to offset these things, but it's not doing enough, and it doesn't look like it will do enough, to be perfectly honest. So the world's 3 largest economies have all got idiosyncratic shocks going at once. And this is amid a broader inflationary outbreak in the global economy that's got central banks tightening everywhere. So we just think that that range and breadth of shocks is enough to really disrupt global economic activity relatively quickly. And then you get suddenly what, you'll find that a lot of the tensions we've seen on the supply side, in particular in the global economy over the last 2 years, will be hit by a demand hiccup, and everybody's efforts to get around those will suddenly gain traction, and we'll have heaps of excess on the supply side relatively quickly. And, that's a very deflationary environment, especially if it becomes recessionary, which we also think is probably the base case. So the two main components as to why economists think inflation will fall back are A, base effects, and B, demand hiccup, supply side loosening, and possible recession.
And so the biggest swing factor, though, that
Base case.
Yeah.
And so if we flip over to our next chart,
actually, sorry, before you do that, Dave,
historical.
so one of the biggest swing factors in that whole conversation is the idea that the lockdowns in China, which is the most that creates the most uncertainty in my mind in terms of saying, could we have significant supply chain disruptions that actually then end up in higher inflation for a period of time, and whether it be another 6 months or another 12 months added on to the whole time frame, absolutely. But the flip side is the demand destruction we're seeing over there probably more than cancels that out in the short term. And I do think there is so I guess that my the bit which I guess I'm watching the closest is trying to work out whether and we don't know yet is how bad is this impact going to be from Chinese supply chains slowing down. I guess on the positive side of it is that that says, okay, the demand destruction in China is bigger than the effect of the supply, and also the fact that companies have already had to be dealing. We've had 2 years of supply side disruptions and building up inventories and I guess the acknowledgement that this is a possibility that supply chains can be disrupted means that I think it's going to be less likely that it'll have as big of impact. Similar to how we saw, the initial lockdowns that everyone was doing had a massive economic impact because there was so much uncertainty. But then as the lockdowns continued, people got used to, okay, I know what I'm doing when there's a lockdown, and I know that my business will still survive. I don't need to lay off a bunch of people. It's even if it lasts for another month or two, I can, you didn't see as big as economic disruption. And I think that's the case as well with this coming out of China, is you won't see as much because the world is, it's not a black swan anymore. It's now a white swan. I know these things exist, and yes, I don't want a disruption to my supply chain, but when there is, I go through my plans of here's what I'm going to do. Whereas I think when it first happened in the pandemic, there was a bunch of people who are just like, I don't even know what I'm going to do when this happens. Who do I call? How do I get alternative supplies? So, yeah.
Sorry, did you hear everything that I just said? Or
yes,
I didn't get cut off. Sorry,
no.
my headphones went a bit wacky. Okay, good.
Yeah, guys, we've just got one viewer question coming through here as well from Peter. So he's just asking how at risk are US corporate bonds this time, because in 2019 they seemed to be the failure point until the Fed bailed them out.
Yeah, well, I mean, they were very leveraged going into 2019. That has actually improved a bit over the last couple of years, with a lot of the largesse coming from governments and support over COVID. Nonetheless, you would expect the Fed tightening cycle to culminate in widening spreads for corporate bonds, especially, and what that means is losses.
And I think we've seen. I think the latest quarter was finally getting back to more normal bankruptcy levels. So bankruptcies for the last quarter was like well above anything we've seen over the past 2 years. So bankruptcies globally over the pandemic were really, really low. Surprisingly low given how much, we certainly got it wrong going into that. Was we were expecting way more corporate bankruptcies, but governments stepped in and changed the rules and did everything they could to keep companies alive. And so that's now fading off, and we are starting to see companies fall over. Whether that means that, I think to a certain extent, as Dave said, that some of the leverage has come out because those companies that probably would have gone broke without changes in the rules and without the government support are then well aware of the fact that they had a very near-death experience, and so now they need to raise equity or lower their debt levels, and so this time around, less likely. But seeing those rise, seeing bankruptcies rise is one thing. The spreads really haven't changed that much. So the corporate spreads, it's largely been corporate bonds shifting up in line with government bonds. We haven't seen a blowout in yields. And
we have in junk, but not investment grade stuff.
Yeah.
Yeah.
And so
But
the question
but
there
it will come.
Yeah, probably. It's interesting to see now. Is there an implied Fed put in corporate bonds now as well, in terms of the, do people look at it and go, okay, last time there was a big crisis, then the Fed actually stepped in and said, I'm going to buy corporate bonds to save you. And so whether you see some more risk taking in that side, with the view that, well, if things do go badly, then the Fed will step in again. But
Well, of course it will.
Yeah.
I mean, once it's crushed inflation to its satisfaction,
Yeah,
it's just judging where that point is.
Yeah, well, that's right. And it can't be intervening in the bond market now, though, given it's winding back its own purchases
No, of course
bonds.
not. No, which is why we say, now's the danger point, and spreads are going to widen, because they always do as you head towards a recession, which is the base case in the US over the next 18 months. So I would certainly expect some losses in even in investment grade US bonds. I mean, given some of that leverage has come out, we may not actually see any kind of balance sheet shock like we were expecting in COVID. We might be able to skip that. You never know. But you're still going to see idiosyncratic problems that will widen spreads. That's almost unavoidable. It's part of the cycle.
Yeah. And the other one I just wanted to hone in that you're talking about as well, Dave, you skipped over a little bit, but I think it's quite important, the idea that, keep remembering what central banks are doing is they're effectively saying, okay, inflation comes from a demand and supply mismatch. We've spent the last 10 years trying to get more demand because we just can't get enough demand into this economy, and we couldn't get enough demand. Interest rates kept falling and wages were really low. Now we've flipped into this economy where wages in the US have been ticking up, but most other countries, wages are actually pretty low. And so what's happening is we've effectively got the US Fed saying we need to smash demand back down to levels where it meets this sort of low level of supply. And the expectation then is, but then if that happens, then we'll be able to flip it back around and turn it all back on again. And that's part of the danger is, well, we tried basically since the financial crisis to flip it back around and turn the demand back on and couldn't do it. So now you're actually, and that was just demand that sort of was naturally falling. Now you're actually going to intentionally smash the demand. Is that going to create issues sort of going forward? And so, not saying necessarily,
I can't remember the last time the Fed engineered a soft landing when it had an inflation problem. There are examples of it around the place, but not in the States. I think in part that's because of the way their corporate, or it's the way their labour market works almost, because they, they're so ruthless there. When they get any kind of distress, they just kind of chop headcount, and you get into an inventory cycle pretty quick in the US when you get any kind of demand hiccup. But anyway, so we do have a pretty good historical analogy for all of this, which we've been using for 3 years basically, and that is what happened after the Spanish flu pandemic in 1918-19. And we saw a lot of the same forces at work. The two key ones are that, the Second World War disrupted the last great period of globalization. The First World War did.
And actually, let me just a little bit of background to that. So basically, there was a huge globalization in the run-up to the First World War, and then that globalization sort of went away for decades, and then started lifting again, and in particular, up until sort of Trump had been growing very, very strongly as well.
Yes. So, the whole global supply chains and outsourcing production to, the cheapest available option, etc., which has been so disinflationary for so long. Similar circumstance leading up to the First World War. So the war disrupts that. There's a lot of what we're seeing today as well with repatriation of production. And so that was inflationary in the period. And then following the Second World War, immediately, we had the Spanish flu pandemic, which did very similar things to what it did, to what the COVID impact did, which was to exacerbate exactly what had gone wrong in the First World War, which is, again, you found yourself with shut down supply chains around the world, etc. That was very inflationary, and people couldn't get stuff that they needed, etc., etc. And so, there was this sudden inflation spike going into 2020, and the Federal Reserve responded as it is now. It took interest rates, I think, from
3.5 to 5.5.
No, that's not right. At least according to what I've read recently, it went as high as 7. Maybe that's quarterly versus monthly, or annualized average or something on that chart,
or a 5-year rate or something.
Yeah, something like that. But it took it about over 2%, 200 basis points higher within about a 6-month period, because inflation really got off the hook very quickly, just as we're seeing now in the US, and the central bank just chased it up, and the end result was just an absolute crash in 2021, where we had basically a depression, about a 6-month depression.
Well, it was a depression. Yeah.
It was a depression, yes, through Anglosphere economies, and we had a CPI at minus 10% in the US for much of the year. Now, there was one other factor in that deflation that was pretty important. That was the demobilizing labour into these economies, and so you had an excess of labour. But I don't think that's the key consideration. Mainly, what happened was, there was an inflation outburst with supply side constraints, and the Fed reacted to it, and so it delivered what we're talking about here, or the Fed's talking about doing today, and that is fitting demand down to restricted supply, and of course they overshot. And so, this is a nice analogy, we think, for where we are today,
and highlighting that we're expecting a less extreme version of this.
Oh, absolutely, yes. I don't think we're looking at a depression this time around. In part because we don't have that positive labour supply shock, but also in a weird way, because I think if we actually get inflation under control and the Fed pivots around, then the financialized economy will swing around very quickly, again, with asset prices, etc. But I do think we are looking at a pretty decent deflationary event. But anyway, just one chart further on here, you can see that we saw 2 years of really hefty deflation in the US, 11% in 2020, and then like another 6 or 7 the following year. So, pretty full-on numbers coming out of this big inflation spike from World War I and the pandemic. So the lesson for that for central banks is that don't overreact, don't over tighten into a supply side shock that you get from a war and a pandemic.
And the thing was, they were saying this. I mean, this is the whole transitory inflation thing. They were saying exactly this argument: don't do this because we're not going to affect it.
Yes.
And then they've changed their tune, obviously, too.
And they've changed their tune, yes. So, and I mean, the main reason for that, I suppose, is some of the labour market tightness, especially in the US, has really spooked them. But the historical analogy is still there. The theory, is you don't use a demand tool to address a supply side inflation problem, and so there you go. So we basically think that this whole thing is going to be a pretty substantial policy error, and so before too long we'll see inflation disappear, and then some pretty nasty or welcome, depending on which side of the fence you sit, deflationary impacts. So shall I just quickly run through the implications for markets?
Yeah. Do you want to go, Sam? Do you want to do your question of the week?
Just
maybe put out to any other questions.
Yeah, so now we've got the question of the week. So this is for viewers to have some discussion in the comment section over the coming days. So the question for the week is it time for a contrarian bond investment? So feel free to post your thoughts and engage with us and some of the other viewers over the coming days. And I just want to make it clear to all our viewers and listeners, if you're having a bit of trouble seeing some of those charts, you can actually download all the slides after the show. We put that up on our website at nucleuswealth.com/content. So that'll be up later today. So feel free to go and download those slides. So yeah, I'll pass it back to
viewer questions. I think we've probably got a few viewer questions first, just to run quickly through, and then we'll hit the.
Yeah, we've got a couple of viewer questions around the Australian economy. So with all these considerations that you've been discussing, do you think the RBA will continue to do nothing rather than raising rates? So that's one question. And then also, what industries or companies do you see benefiting from the onshoring in Australian manufacturing?
So in the RBA, yes, I think they are going to raise rates now. I more or less agree with CBA. I think they won't get terribly far, maybe 1% on the cash rate, a little above. But Australia's kind of lagging the global cycle by a quarter or two, so might just have the space to shove the Australian economy into the crash that's happening all around them, as it did, in 2008. So I don't expect rates to go to the moon as markets do at all, but it looks like we are going to have some hikes, yeah. In terms of onshoring, lordy. Well, I mean,
yeah, look, we do a lot in the large cap Aussie market, and there's not a lot of companies there that are benefiting. In our international portfolios, we're absolutely got a number of companies that are involved in robotics. Got a number of companies involved in a lot of electrification that we have within those portfolios. So so absolutely have a look at the ones we've got in our international portfolio there, and there's sort of write-ups on each of those for any investors in terms of which ones we're holding and why we're holding it for those reasons.
Okay, great. Thanks, guys. So let's move on to investment implications.
So I guess just to wrap it up, I mean, I expect basically the Australian curve to follow the US with a bit of a lag, and as noted, the curve's already flattened here a fair bit. I think it will invert at some point in the not too distant future. Whether that's a bull or a bear flattening is of interest to everybody. It'll probably largely be driven by yields rising at the short end of the curve, that is in kind of the 2 to 5 year range, and then further out 10 and 15. Are we at the pivot point yet where those yields start to fall? They've certainly been struggling a little over the last few weeks, and they will be influenced in Australia in terms of what happens in the US as well, whereas the short end won't. But over a kind of 6 to 12 month horizon, I would definitely see some kind of inversion coming to Australia as the globe kind of falls apart. We're still pretty bearish on stocks. We think there's an earnings recession coming, and that's just not priced into multiples at all as yet. So there's plenty of downside possibility there. On top of that, the inflation outbreak in the US has really lowered the Fed put, and it also needs to get a bit of a commodities bust going for it, I think, to satisfy itself that it's put the inflation genie back in the bottle. So that means the Fed's still got a hike on, probably more than the RBA can manage for the reasons we've discussed today, especially the mortgage rate at reset. And so we've been championing this US dollar bull market now for a couple of years, and it looks like it's basically on its monthly chart, it's already broken out to 20 years highs. It's threatening to do that absolutely right now, and I think it will. So I think we've got a real blow-off scenario ahead for the US dollar. So I think the Australian dollar is in quite a bit of trouble even though the RBA is moving to hike now, I think it'll become apparent relatively quickly that it can't go quite as far as the US. So a 6 to 12 month time frame. That more or less wraps it. Like, we're still sort of moderately long bonds, awaiting the rolling over of yields. We're mulling what when to get longer to ride those yields down. We're very short, or not short. We're very, very underweight equities, and we're very long cash. Looking to deploy that money when we see capitulation in stocks, and the central banks pivot back to growth when they're satisfied inflation is contained.
Okay, excellent. Thanks for that, Dave. Damien, have you got any last thoughts you want to add to that?
No, I think it's a pretty good wrap.
Okay, fantastic. So I just want to take a moment just to educate some of our listeners about the Nucleus Wealth offering. So we offer all our portfolios across the full range of account structures. So we offer personal super, so you can invest your superannuation with us. We offer investments through self-managed super funds, individual accounts, joint accounts, trust structures, and you can also invest via your company. So there's full flexibility in the way you can invest, and please go to our no obligation onboarding portal to see more information. So that's located on the homepage that you can see there at nucleuswealth.com, and click on the blue button in the top right-hand corner. It's the Get Started button. Only takes about 10 to 15 minutes to get set up with us, as it's fully online and there's no obligation to proceed with anything. You can get to the final review page and download a statement of advice showing the recommended portfolio or the portfolio that you choose. And within this SOA, you'll see every individual security in the portfolio, an accurate breakdown of the fees, as it has all the information for you to do your due diligence on us, and to really make a fully informed decision and understand if investing with Nucleus Wealth is right for you. So that almost wraps us up. So Damien, I just want to thank you for sharing your insights and knowledge as always.
Thanks, Em.
And Dave, thanks for your informed and valuable opinions also.
Sure, great, team. Thanks for having me.
Okay, so we do welcome your feedback on this podcast, especially in regards to suggestions for future topics. If you do have any ideas, please drop it in the comments below or send us an email at contact@nucleuswealth.com. Just a reminder, this is general advice and does not take into account your personal situation. If you do want to discuss your financial situation, please go to our website at nucleuswealth.com and book a call with me or one of the team. Don't forget to like the video now. And finally, if you know of anyone that might get some value out of today's episode, we'd really appreciate it if you can please share it with them. Also, if you'd like to see more of our previous episodes and content, head over to nucleuswealth.com/content. And to stay up to date with us, with news from us, you can follow us on all social media. So for myself, Damien, Dave, and the rest of the team at Nucleus Wealth, thanks for watching, and we look forward to seeing you next time. Bye for now.